Hello everyone, welcome back to my channel. I'm your host Miss KK and this is The Wave. It is your weekly show that looks at topics related to personal, family and business finances, and our hope is that by the time we get to the end of the series you are really better equipped to make sound financial decisions. If you are new here, thank you so much for stopping by. We really appreciate having you on board. And if you're already a returning subscriber, an awesome appreciation to you guys for always engaging with our content on YouTube as well as on our other social media platform. We really appreciate that. All right, today I'd like to continue with our financial statement literacy series, where I actually started educating the ordinary Namibians to start understanding the basics of financial statements. The reason why I'm doing this is because there has been some activities in the stock market. We saw Letseho listing, we saw Standard Bank listing, we saw MTC recently listing, and a lot of ordinary Namibians have started buying shares in these companies. And we're just making sure that whilst you bought shares in this company, you are actually understanding the information that these companies are pushing out to you, and you are actually digesting it, processing it, and actually making an informed decision. When you have shares, you generally are faced with three decisions that you need to make. Number one, whether you must increase your investment in this company because you really believe there's potential growth in this company and you want to be able to capitalize on that. Number two, you really think your investment is doing bad, but actually you aren't willing to incur the losses now. So you're holding onto this investment because you think in the short term it's likely to recover, and then when it recovers, you actually sell. And number three, you are actually convinced that this company is not going anywhere. You might as well cut your losses anytime and exit the company. So using the financial information that the company is pushing out there, you can then come to any of those three conclusions. All right. So as I've mentioned in the previous video, companies normally have financial year end. They don't generally have to coincide with a calendar year. It can start at any month and end at any month for as long as it's a 12-month cycle, with an exception of the year in which the company is incorporated, because those in those particular year a company is allowed to go, I think, up until 18 months. So Standard Bank's financial year really coincide with the calendar year, so they released this condensed results on the 31st of December 2020. I did find this information on their investor relation on their website. Because it is a listed company, the information is publicly available for me and you as shareholders to actually go and look for the information. So it's not confidential information. If you want to look for it, go on their website, go on investors relation. The most recent document that is there is the information that they recently released. So as a shareholder, you make money from a company in two ways. You either hold that shares and it appreciates in value. For example, you buy the share at $1.50 and then you hold it until it reaches $3 and you sell it, and by the time you've sold it, you've actually made double. The share has actually doubled in value, meaning the extra $1.50 that you made is the capital appreciation. That is the first way for you to make money in shares. The second way is for you to hold that shares, and hopefully during the course of you holding that share, the company then actually declares dividend to you. So dividend is very important for shareholders, but it also depends on why you invested in a company. Some people are investing because they want dividend, they want income now. Some people are investing because they want to be able to cash out their shares at some point and have money at a later stage. All right, I'm very excited to now start looking at some of the highlights that are released in the results announcement for Standard Bank. And to start off with, they have given with prominence the final dividend declared per ordinary share. So as I've mentioned in my previous video that I did on share investment, the first thing that you need to understand is it's not an obligation for a company to declare dividend. The company may declare dividend if they think there is enough resources for them to be able to pay out dividend. Remember, a dividend is equity, it's a residual interest. It's not an obligation, it's not a loan. The issuer of the instrument, the issuer of the shares, is not obligated to pay out any dividend. So Standard Bank here is saying that they have declared dividend of 15 cents a share, which is final dividend. Okay, so a company can also declare dividends twice a year. They can declare what is called interim dividend, which is the dividend they declare during the year, and then they will declare final dividend, which they normally do towards the end of the year. At year end, it might not necessarily have been paid out. It might be paid out after year end. So if you are a Standard Bank share holder, for example, and you see they have published that they've declared 15 cents a share, and you are wondering why you haven't received your dividend, if your bank accounts haven't changed and you still received your dividend in the same account last year, they are possibly just also sorting out the admin around paying out dividend. Because it's a lot of shareholders, there's also a lot of admin involved, especially the fact that these shares are publicly traded. Shares can continue to change hands at any point in time. So the company secretaries or the transfer secretaries need to actually freeze who the shareholders are at, when the dividend was declared, and decide who is eligible for that dividend. So that is just the one thing that they've highlighted. All right. Then they have said that they've made actually profit for the year of about 371 million. So I want to touch on the key financial statement that are normally included, or the key statements that are normally included in the financial statement. The one thing that you need to understand is the balance sheet. So a balance sheet gives the value of a company at a point in time. It normally has roundabout, you can say, 3 segments. It has the asset segment, it has a liability segment, and it has the equity segment. To explain in simple terms, your asset are resources that the company owes, and it's normally split between long-term assets, those assets that it would take time for the company to actually realize the value. For example, if the company has a building, it will be a long-term asset, and it will also have short-term assets, those assets that are very liquid and can be easily converted into cash. So for example, the money in the bank account, and for example, trade debtors, people that owes the company money and they need to pay back within the 12-month period, for example. So that's normally the asset portion of the balance sheet. Then you have your liability, and liabilities are normally the opposite of asset. Liabilities is an obligation that the company has that will result in the company paying out money from its bank account, for example. And you also have long-term liability. For example, if you have a 20-year bond on a property that you bought, that loan will be a long-term liability. But if you just took an overdraft because you didn't have enough money to pay your salary, for example, at year end, that would be a short-term liability. And in between here, which you call the residual, is my equity. This is the share capital that you as shareholder has pumped in the money, and cumulative profit that the company has decided to keep in the company that they haven't distributed to the shareholders, and obviously other reserves if they are. So basically that's the statement of financial position. So I see here Standard Bank didn't include the statement of financial position in their condensed or in their results announcement, and there could be various reasons to that, because you need to understand what drives specific industry. There are certain industry where if you are a property company and you are going to release condensed results, you would want your shareholders to know the value of your property. So it's very likely that in the results announcement of a property company, you would find the balance sheet being given more prominence, because that is the value driver for the business. Whereas for the banks, for example, their main business is normally to generate income from the loans that they've given out. That's why they've given more prominence on the income statement. So I've explained that there are a couple of statements that are normally presented in the financial statement. The first that we've already touched on is the balance sheet. The second I want to touch on is the statement of profit and loss, or statement of comprehensive income. That is normally just the statement that summarizes the performance of the entity during the 12-month period. So it will normally have income, money that the company has generated. It will have expenses, money that the company has paid out, and it will have the profit, which is your income minus your expenses will give you a profit. Okay. So what Standard Bank is then saying here is that they have made 371 million in profit this year, and compared to 2020, which is the year before that, they've made 421. So the other thing I also want to mention here, financial statements will always be presented with 2 years at minimum, except if there's a restatement, they might add a third column. So the reason why they give you current year and prior year, which is 2020 and 2021, is to allow the investor to be able to do a comparison and to be able to do an analysis to say, have my company performed better compared to last year? And if they didn't do well compared to last year, what were the key factors that influenced performance? So the one thing that is very clear here is that COVID has played a big impact. The economic growth has slowed down. Obviously, the economy is slowing down. The loan that the banks are issuing is very slow compared to the previous years, because the appetite for you and me to go get a new home loan in the times of uncertainty is very low. So that is the reason, partly the reason why the bank could have performed poor. So that is one of the things that they have presented. Then they've presented 2 key ratios, right? So any given industry would have ratios that are very important to them. And remember, ratio is just metrics that are used to determine the performance of an entity. So for example, if you go to a mine, one of the key ratios that they might monitor on a yearly basis is fatality rate on the mine, for example. If they are able to keep their safety regulation on par, then people don't die on the job. That is a very key ratio for them to present in results. Whereas for the bank, they've realized that net interest margin, the percentage that they make as a profit on the loan that they give you, because remember, the bank borrows money and then they take that money and they give it to you. So how much do they make from lending it to you versus how much they get charged from borrowing? So if we have to put some context to it, you have the central bank, you have the commercial bank, then there's me and you. So the central bank in our case would be Bank of Namibia, the commercial bank in our case here would be Standard Bank, and there would be me and you. So Standard Bank, say, would go to Bank of Namibia and borrow money, and Bank of Namibia decides to charge Standard Bank prime, and let's just say for argument's sake it's 4.7. And then the Standard Bank lend this to me, and then they charge me prime, which is currently a 7.75. So the difference between 7.75 and the 4.7, I forgot what I mentioned here, is then the net interest margin that the bank is actually making. So this is a very key figure, because that is the essence of the financial industry, is to make money from lending it out to people, and you're always going to try to lend it at a slightly higher interest rate than what you are charged when you borrow that money, so that you actually are making profit in the end. So those are the three things that the bank has presented. They've obviously presented another ratio, but I don't think it's necessary to go into that ratio, because you might not be able to comprehend, given that this is really just a basic introduction. The aim of today's video was just to highlight the 4 statements that are normally included in the financial statement. I've already spoken about the balance sheet. I've spoken about statement of profit and loss, or statement of comprehensive income, and I want to touch on the last 2 statements, which is the statement of changes in equity and the statement of cash flow. The statement of changes in equity deals with transactions that are normally with the shareholders, so equity owners, which means you that own shares in the company. Your transaction would go in the statement of changes in equity. So the typical transaction that would go in the statement of changes in equity would be if the company issued new shares, or if the company declared dividend, or what profit has the company made that they are closing off to their statement of changes in equity. Why this is important to you as a shareholder is that, number one, you need to see if the company has issued more shares. If the company has issued more shares, it has perhaps, it has maybe perhaps diluted your ownership, or it might actually, give you an indication of whether the company is looking for further financing. And you might be interested in knowing why are they issuing more shares, because remember, the company is issuing shares, they're actually essentially getting, finances to use that on whatever outlook projects that they have. That's the statement of changes in equity. Also, just to check the dividend declared. Like I've mentioned, dividends are normally paid to shareholders, so your interim and your final dividend would actually be sitting in your statement of changes in equity. And to close off here, we are going to close off with the statement of cash flow. The statement of cash flow really just summarizes the movement of cash between the 12-month period that we are currently looking at. The statement of cash flow is divided in 3 main sections. Is your operating activities. These are cash flow that are principally related to the day-to-day operation of the company. So for the bank, it would be, them lending on money on a daily basis, that the money that they generate from interest on loans, that will sit in your operating activities. And if you are a retailer and you are selling cars, the money you generate from the sale of cars, that will sit in your operating activity. Then you have your financing activities. Financing activity really just relates to the activities that the company did to either look for new financing or to repay finances. So if you to repay your financing arrangement. So if you take on a new loan, or if you repay your loan, it will normally sit in your financing activities. And lastly, it's investing activities. These are normally, activities that are related into company investing in things that will generate more money in future. For example, if you buy a new rental property and you want to generate rental income in future, your rental property acquisition will sit in your investing activity. So if you may be a unit trust, for example, hoping that you will generate some money so that you'll be able to pay your shareholder a dividend at the end of the year, that investment that you make will sit in the investing activity. So basically, those are the key statements that are normally included in the financial statements. So remember, like I've mentioned, you are going to go to your annual report wherever you get it, and then you are going to be looking at the index. I said don't just go flip around, look at the index, and you must look at the annual financial statement. So if we use this NAM Breweries integrated report, the annual financial statements are on page 80. If I go on page 80, you would then, the annual financial statements are also a series of documents, and the annual financial statement would have its own index. So if I go to the annual financial statement and I want to look for the statement of financial position, which is the balance sheet. So here I have statement of financial position on page 93, statement of profit and loss, which is the same as statement of comprehensive income, is on page 94, statement of changes in equity is on page 95, and statement of cash flow is on page 96. So just to recap, you would take your annual report, you go to the index, then you go look for the annual financial statement. Remember, the integrated report has other things that are not related to annual financial statement. And then when you go to the annual financial statement, you find another index to guide you with where to find the information within the annual financial statement. And you must look out for those 4 statements that I've mentioned in order for you to be able to orientate yourself. I hope this has really clarified one thing or two. I am then going to do another video where I actually now go look at the detailed balance sheet and sort of break it down, what each class of asset means, what it would mean for the company, maybe interpret NAM Breweries results, maybe interpret Paratus that has a similar result as a Standard Bank that was recently announced, and really just hope that you understand to be able to make informed decision when you are buying shares, or when you are deciding to either hold or sell your shares in a particular company. That was all I had from today's discussion. Thank you so much for tuning in. Please don't forget to subscribe, and until next time, it is goodbye, and as usual, stay safe. Bye-bye.